Good morning, everyone. Today, we're going to kick off a day with a panel on navigating structural shifts, regime changes, and macro shocks. My name is Stas Melnikov, and I lead quant research and data solutions for SAS. My team provides daily forecasts of corporate credit and does modeling of corporate credit, interest rate, and liquidity risks. On this panel, we have experts covering full spectrum of perspectives, ranging from macro to market microstructure levels. Let's start by doing a quick round of introductions.
My name is Brianne Doherty. I work for Bloomberg. Specifically, I'm the head of thematic strategy within Bloomberg Intelligence. What that means is we're basically redefining the equities landscape, something that when I entered Bloomberg Intelligence a few years ago, we were looking, to build out an equity strategies group specifically through a thesis-driven lens. And we've done that through this category building product with over 2,300 equities mapped to themes as opposed to sectors, and really being able to drive a new type of equities research on the global market. So that's what we focus in, everything from AI to grid tech to genomics to novel neural mental health. It's been a really fascinating ride, and hopefully we can provide some great macro perspectives because of that.
My name is 𝐸𝐢𝐿𝐼. I work for Scotiabank. I oversee the equities and FX market making. So we work in low latency, high frequency infrastructure and market making bids and offers to clients. And in this area, we look at microstructures, volatility regimes, and minute-by-minute return structures in a very low latency space. We adopt AIs and machine learnings to help us navigate through those space.
My name is Igor Yelnik. I manage a company called 𝐸 Capital. We're based in London. We manage a systematic global macro fund, which is uncorrelated to other systematic macro, to other hedge funds, to major asset classes like equities and bonds. The way we approach the strategy is like exact opposite to what Julius is doing. They are very fast in their trading, and we are extremely slow because we look at macroeconomic indicators, we look at fundamental data, among other things. Quite a lot of our risk is concentrated in relative value models rather than in directional models.
I'm Mark Shore. I'm an economist at the CME Group in Chicago. We only have 2 economists, so 50% of the team is right here up on stage. I started with the CME in July of last year. Prior to that, I was finance faculty at DePaul University, primarily teaching courses on risk management, alternative investments. But I spent most of my career in industry. I started on the floor of the Chicago Board of Trade, working both in the bond room and the grain room. And last year, I defended my dissertation, which is on alternatives, and officially became Dr. Mark.
Thank you for those introductions. Let me say a few words to set the backdrop for our conversation. The 2020s have been quite a decade so far. We had the COVID-19 pandemic, we had the rapid advances in AI, we had launch of ChatGPT, which ultimately marked a structural shift across virtually every risk and return dimension. At the same time, we had reemergence of inflation, rising interest rates, and continuing fiscal deficits that place us in quite an unprecedented space from a government debt level perspective. Asset prices have gone up, stock markets notching new highs, corporate credit spreads are at the bottom decile of the historical range. Everything seems to be priced to perfection. The expectation of continuing advances in productivity driven by AI, automation, quantum, fusion, biosciences, to name a few themes. It's an exciting time to be alive. Where we go from here is far from certain. So looking at our corporate credit models, if you just look at the top 3,000 companies in the United States, we are in 71st percentile from a median one-year default probability perspective, with the first percentile being the lowest and 100th being the worst. If you look at the 3-year default probability, we are at the 54th percentile median. So this type of environment is typically consistent with a late-stage credit cycle, which is not what markets are currently pricing in. At the same time, we also see the pace of meaningful events have accelerated, and what is even defined as a meaningful event has changed quite dramatically. So we have lots of signals. Those signals are coming in fast, and separating signal from noise become a challenge.